Well, g'day. This is the trade-off. Now, what we're looking at today, we're seeing equity markets continue to find their Goldilocks backdrop. US equity pullbacks are minimal, and we're seeing new all-time highs coming through in the S&P and the Nasdaq. Yeah, tech's working really well. That's continued to outperform. We're seeing a ripping move in Broadcom. The SMH is breaking out to the top side. That's where the flows are going at the moment. That's where the outperformance is seen. Now, will that continue? That's something we're watching very much indeed. But we are seeing tight ranges coming through in the S&P, very, very tight ranges. It's much of a grind. We've got very low implied volatility coming through with the VIX at 15%. As I say, we've got this kind of Goldilocks scenario, which, yeah, we probably didn't anticipate. We probably expected to see a little bit more volatility than this, but the market continues to grind up. We ask whether this continues. Obviously, we've got CPI coming out in the session ahead. That can be reasonably meaningful for rates in terms of CPI for the US dollar and ultimately what this means for Fed policy. And we understand the playbook that surrounds that situation. And we also look at what's happening in gold. Can this beast of a juggernaut continue to move up in its continued trajectory? We'll obviously ask those questions as well. We go through the charts that matter. This is the trade-off. Well, hi there. My name is Chris Weston, Head of Research at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And we were discussing these world of markets, the technicals that matter, the price action, the movers and shakers, and what we like from a directional perspective and understand sort of where the risk parameters and what could kick some life back into these markets. So coming to the show, Mr. Blake Morrow. Pretty sad day for you out there at the moment. We're just seeing some awful news coming through. Apart from that, how are you feeling? How are you trading the markets?
Well, as far as the markets go, Chris, it's been kind of choppy waters. We got some weak producer prices, which sets us up, kind of tees us up for the CPI tomorrow. Equity markets rallied, but the dollar's been kind of stagnating around here. I think waiting for some cues. And you're right. Today was a very sad day, and is a very sad day in America. For those of you that are not following or are not following the news. A political activist on the right. His name was Charlie Kirk. He was assassinated today, and he was a father. He was very popular. He was a husband, and his life was taken way too early. Whether people agree or disagree with what he had to say, the fact of the matter is he promoted what we as Americans cherish as our freedoms. And the right to have an opinion, to speak our thoughts, to debate and have healthy debates, right or wrong, whether you agree or disagree. And to lose somebody like that in the United States it is a very sad day. So excuse my lack of enthusiasm, but I am enthusiastic about what the markets will be giving us in the days ahead. I've got some good plans set up, and I can't wait to share them with you guys.
Yeah, well, I know he's from your area, so obviously that hits harder indeed. But obviously a father of 2, so very sad thoughts to the Pep family there. But anyway, let's go into markets and let's go to Topical Thunder. All right, Blake. Let's start with the markets. Let's check the market pulse. We've got the S&P grinding high. Now, we are seeing a bit more concentration in breadth. Yeah, we are seeing tech really emerge as that dominant beast again. We're seeing Apple roll over a little bit, but we are seeing Broadcom ripping to the upside. For a large portion this week, Alphabet's been finding a lot of love. That's the teaming up with Broadcom effectively and potentially cutting a bit of Nvidia's lunch. As they push out their TPUs. I think it has seen the stock trade up to 240. We're finding a few sellers and a bit of a ceiling into the stock. I wouldn't be chasing at those levels, but there has been some big moves playing through in the AI space and semis. As I say, look at the SMH on a daily chart that's breaking out. You've got the dollar, as you said in the synopsis earlier, is still continuing to trade a tight range sideways, but we are seeing some breakouts and the crosses in things like Aussie dollar. I like that fundamentally and tactically. I still think that outperforms against things like the yen and certainly the euro and some of the sort of more political high risk premium kind of currencies. Gold holds in pretty well, but volatility is still pretty low. So what are you seeing sort of the overall situation in terms of risk? Do you still like, is it, how are you liking equities? How are you liking FX on risk? Where's your views?
Well, first of all, I love the equity markets into the FOMC this next week, especially if we get a weak inflation print tomorrow. So it's a weird month. Usually we get producer prices after consumer prices, but most people know that producer prices feed into CPI. That doesn't necessarily mean it's going to be that month that producer prices are lower like they were today, that it's going to translate necessarily into lower prices for the consumer. But there is an argument to say that there is a correlation there. If we get a weak inflation number, that's going to set the stage for expectations to really go up, Chris, for a 50 basis point cut. Now, I'm totally not in that camp. I don't believe that the Fed is going to deliver what the market hopes that they want, but the markets run on expectations. So if we do get a weaker CPI print, there is a good chance that we could see new all-time highs like we did today in the S&P. Broad markets will rally as expectations are going to increase for a cut. Now, that's going to set us up for what I wanted to talk a little bit later going into the FOMC, because I have a big plan on how I want to trade this all. And I can't wait to, like I said, I can't wait to share it with you. But here's the thing about the dollar, Chris, is the dollar has not acted well despite the data. Let me rephrase that. The dollar has traded very well, not the way you would think based on the jobs revisions that we got yesterday here in the U.S. The producer prices coming in weak. The dollar still trades pretty strong, and I think it's more of a risk of positioning at this point. I mean, I had a trader that is a very active trader in our community. That he's a big prop trader for a brick and mortar prop firm in New York, and he made a great point. It's like, hey, the rally that we've seen in the euro this year in 2025, or the weakness we've seen in the dollar, is somewhat unprecedented. Doesn't mean it can't continue, but you can see why there is two-way price action at these levels. So I think a CPI tomorrow is really going to set us up for some good moves going into the end of the week.
Yeah, I mean, I think with the dollar, just on that point quickly, I don't know necessarily it's a huge crowded short. I know you look at things like CFTC and bits and pieces. I think it's a crowded discussion, but I'm not sure necessarily. I mean, I think there's a wave of selling still to come from hedging activity, and I think a lot of the fast money asset managers who have, the asset managers who have to currency hedge on a shorter basis, shorter term time frame. That's all happened. That happened a long time ago, and people talk about hedging ratios of dollar assets, but the slower moving entities, the insurance companies, the pension funds, they have to go back to their committees and get it signed off, go back to their clients. And that takes a long time. We're talking months and months. And I still think that's due to happen probably from the start of Q4. So I think we're going to see hedging ratios really push up. I think that those flows could be something that perpetuates or causes another leg lower in the US dollar going forward. So something that obviously we need to consider.
Yeah, and again, it can really start with tomorrow. So I want to jump topics over to our next topic with the CPI. As I was saying a little bit earlier, Chris, that producer prices, they tend to come out after CPI. So usually you get this 1-2 punch. CPI comes out, whether it's hot or weak or whatever it is. But then you get producer prices right after that. So you always have to keep your guard up, no matter how you position yourself post CPI. But this month you have producer prices coming out before CPI, which doesn't normally happen. But like I said, there is a correlation. There's been arguments made in the analysis community that the weak producer prices could produce, or at least there's a high correlation that higher correlation that consumer prices could come in a little soft come tomorrow. Now, I believe that, and I hope, I'm talking my book here, Chris. I am short dollars right now. I would benefit if CPI came in weaker than expected. I'm not sure if I'm going to hold that position going into tomorrow. We'll have to see where we stand about 12 hours from now. Let me make sure I'm looking at my clock right. Yeah, about 12 hours from the time of recording, I'm going to be making the decision whether I want to stay short dollars. But I do think that a weaker number is gonna finally unlock some dollar weakness. We might get the euro back above 117.50 towards 118. Now, the flip side is I have to mention, and I just mentioned it a second ago, but I have to reiterate that the dollar has acted well despite this huge downside revisions that we saw yesterday from the BLS. This is over 900,000 jobs that we've been trading off of. Obviously, the numbers are a lot worse than what we've been trading, yet the dollar's holding up. Producer prices came in 0.4 month over month, both headline and core, weaker than expected. The dollar, could barely get off of 117 on the euro. The euro is just kind of pegged at 117. So I do think that if we have a strong number tomorrow, it could also produce a pretty darn good move to the upside. And I know you have some setups regarding this, but it's just something that I wanted to talk about because I think it's kind of strange how the dollar has reacted the last couple of days. How are you seeing CPI, and where do you see it falling in over the next 12 hours?
Well, I have no edge in terms of forecasting where CPI is, like, similar to you, I'm guessing. But what we can do is try and understand the sort of whether there's the risk in markets, whether skew of risk, whether there's an asymmetry, or whether there's a sort of a distribution, normalized distribution to the potential moves that we're going to see on a cross asset basis. And I think from an equity perspective, I think it's not as easy with CPI just to say, oh, we've got a hot number. We've got to take the components out of the CPI basket that feed into the PCE calculation and then add them to what we've seen from the PPI numbers. And that will give us an understanding about what the Fed are going to be looking at much more on setting policy to. But obviously a hotter CPI, core CPI number, 3.2% or above, brings in an element of right tail risk. But we're looking at, the components of that, core goods, for example, is really what we're watching. We know services is likely to fall, but it's the read through from tariffs into core goods, which I think is going to be a really big issue for markets, because there's still a lot of businesses which still haven't passed on any of the costs. We've seen that from anecdotal evidence from regional Fed members. So I think there's still a large pass through that needs to go, because at the moment, tariffs are really just a tax on businesses. It's not really a tax on the consumer at this stage. So I think, simplistically, I think over 3.2%, and you get a nice dollar rally, and given that what we've seen in the rates markets and front end yields, and the strong rally of late, I think you get a bigger sell off in terms of short term rates on an upside surprise than you would do lower yields on a negative number, or a more benign number.
Yeah.
I think the equity market would love that. They would love to see this issue where we've got rate cuts coming through, but less troublesome inflation risk. I think would be a beautiful setup for a market that's already pretty hot. I think I can tell you where the risk is going to be. I do think if we get a number, let's get a surprise on core CPI 3%, or certainly below with a 2 handle. We've got a market that's pricing about an 8% chance of a 50 basis point cut. I think all roads at the moment lead to a 25 basis point cut next week, and a Fed that shows a commitment to opening for further rate cuts. I think that's where the shift will be. But from a market pricing perspective, anything with a 2 handle, which would be a downside surprise, 2.9%. I don't think we're going to get any lower than that. But I think then you get rates pricing saying we've got 8%. I think you probably could go up to 20-25% chance of a 50 basis point cut, and then obviously that takes the dollar down. So I think there's a lot of permutations here. One is the tariff read through core goods. We're looking at that. We're looking at the various parts of the CPI basket from core CPI that feed in the PCL calculation. And we're asking what does this mean for rates pricing? It's not going to take a 25 base. I don't think there's any number really, unless it was ridiculous, that would take a 25 basis point rate cut on the table. So I think that's an interesting one, which is why I'd be looking to sell dollars on the CPI into rallies. I think you talk about the dollar and how it's been trading. Well, I think that's largely a reflection that we've got terminal pricing of Fed funds 2.9%. I've got a chart on that. So we've priced in a terminal rate that's now slightly below the Fed's long run estimate, and you've also priced in an element of 50 basis points for the September meeting and 65 basis points for December. So the rates market's pretty rich and full, and I think that's containing the dollar downside at these levels. So interesting one. Let's go to gold. It still continues to be a hot topic of debate. We've got prices just sort of consolidating at the moment. people have tried to fade the move, thinking it's gone too far too fast. But they've had to sort of surrender that position, as it's just really been frustrating because it hasn't. Pullbacks have been quite minimal. But we're just consolidating ahead of CPI, and obviously I think we're going to be watching the dollar reaction. Obviously, we're going to be watching the real rates argument here. But I think everyone continues to focus on the idea of gold, being bought because of central banks, EM central banks, being obviously increasing gold as a percentage of their reserve. That to me has been the primary kicker. The dollar story. But it's not really just been a dollar story. Gold's been rallying in all currencies. And I think the other factor is as well, you've seen a lot of flow-based activities recently. CTAs chasing the price higher, maybe some options hedging as people buy calls, and it's obviously they're having to hedge their delta. And I think as well from an investment management perspective, Blake, we talked about this before, but what we want from an investment management perspective, multi-asset perspective, is you want an uncorrelated asset in the portfolio that's working, and gold does that beautifully. It's got a zero correlation with the S&P on a 120-day basis. It's got a very modest negative relationship to treasuries, but statistically it's very uncorrelated. And so what you're trying to do is you're finding to lower the variance in your portfolio, you want an uncorrelated asset to increase the diversification, lower the variance. And gold does that beautifully because of the lack of correlation, but it's also a hedge or an asset that's working beautifully, not just this year, but take it out since China started buying back in 2022. So it's working well. So for me, I wouldn't be chasing at these levels. I think, it is consolidation, and, perhaps by strength. I think, buying a swing into sort of 35.50 would give you a better entry point, but it really depends on who you are. If you're an investor, I think you're less price sensitive. As a trader, obviously entry points do matter. So I think it's an interesting one. But where are you seeing the risk right now?
Well, as long as we're above 35.10, there's no reason to be bearish. Gold continues to track higher. It's got this really small rising channel, well, narrow, I should say, not small. It's just a narrow rising channel on an intraday basis. Most of you have probably seen it. You know exactly what I'm talking about. And upside targets for me are, 37 and a quarter. So 3,725. It's 161% extension of the last major move lower. I actually believe that the day that you're going to be selling gold, and you're probably going to be selling stocks, is going to be the FOMC day. And believe it or not, I think that's the day that
sell the fact. Sell the fact.
You're going to sell the fact. And that takes us really to our last topic, Chris, because I've been trying to, I want to talk about the Fed, because we're obviously, the next time we meet, you and I meet, we're going to be meeting post-Fed. So it's good to have this discussion here. And I've been trying to yell from the rooftops, whether it's my weekly video, my week ahead video, whether it's our daily videos here. I'm trying to just jump on every rooftop I can, just talk about, my plan going into FOMC. Again, I've been hoping that the PPI would come in weak. It did. I hope CPI will come in a little benign. It allows the stock market to really rally into the Fed. The Fed the market starts pricing in the probabilities, 25%, 30%, whatever it is, that we might get a 50 basis point cut. And when the Fed delivers the cut, I think they are going to open the door, as you pointed out. They're also only going to cut 25 basis points. The Fed chair, he doesn't want to be, they're conservative. They are reactionary. And yes, there are some pressures. So naturally, is he going to cut rates? Yes, I think it's fully priced in, and I believe that to be the case. But if I think the market will be disappointed that the Fed doesn't deliver 50, or at least they would have hopes that they would. And I think you're going to get the buy the rumor, sell the fact, not only on gold. You're probably going to see the stock market show a reversal next Wednesday. And that's the way I'm trying to prepare for the Fed. That's my plan. Doesn't mean that that's going to happen, because we could get a hot number tomorrow. But my plan is coming to fruition, and that's the way I want to trade it. So how are you looking at the FOMC as we go into next week?
Well, again, if we saw a hot CPI, core CPI at 3.2 or above,
goes out.
Cutting into that.
Yeah. All goes out the window. All goes out the window.
No, right, yeah, sure. Well, no, I mean, the 25 basis point cuts still happen, but the market will be a bit concerned by that. Cutting into a rising inflationary environment, is not good. Although obviously they're taking the labour market as the more evil situation. But I think at the moment my base case is before CPI is that we get a 25 basis point cut. That near 10% premium for a 50 may disappoint people, but I think realistically, most, the modal view of the market is firmly that a 25, we're not going to get an outsized cut of 50 basis point cut unless we were to see inflation becoming, very benign and not troubling the market. But inflation expectations are very well anchored. You look at 1 year swaps, 2 year inflation swaps, or 5 year break-even swaps. They're just basically moving sideways. They're very well anchored. The expectations of the market is that inflation is in a really kind of sticky but nice spot. But 25 basis points the call. I think the question then becomes is, will we see any dissents from the Fed boards? I don't think we will, actually, to be honest. Even though Lisa Cook's under the microscope and she's going to be able to vote for this meeting. She is a bit of a dove, and I don't think she's going to come out and do anything that is revenge in any way to Trump, even though she probably could. But 25 basis point cut, market might get a little bit disappointed because we don't get 50, but I think most people in the market see an outsized cut in this environment as a big step, beyond reality. And I think a 25 basis point comes, and I think we then see a strong commitment from the Fed to ease again going forward. The question then becomes is what we've got 65 basis points of cuts being priced in by the end of the year. That implies, 2 cuts, and a bit more for another one. So there is an element of that being priced in. Will the market meet that situation? I'm not sure they necessarily will, but that's where the volatility in the dollar and the rates markets comes. But always, what we ask for in these situations with CPI, as a risk manager, Blake, you always have to ask this question. There's 2 questions. One is, what's the propensity for volatility and movement over a market? Let's take the dollar, for example. That's the first question. Are we expecting movement? If yes, manage that. Look at your position sizing. Second thing, is there a skew in directional risk? Is it asymmetry, or is there a more normalized distribution in the potential outcomes? And obviously, we look at positioning, we look at the moves that's gone into that market. And these are the questions we've got to ask. What if we're going to have a big move in the dollar to the, if we're going to have a move in the dollar to the upside on a CPI beat? Is it going to be bigger than the potential move to the downside on a more benign print? These are the questions you always have to ask yourself as a risk manager. And something I'm going to be focused on with my dollar trades tonight. So
wise word.
Anyway, why like an owl? I am like the owl of finance. Anyway, let's move on to let's go to that's a setup. Right, take it away. Let's go Aussie yen. Real men trade Aussie yen. Breakout City. I love the Aussie at the moment, and that scares me, but I do like it tactically, right? You've got this nirvana backdrop for the Aussie at the moment, and you're seeing that reflected. Aussie against the US, you can always put that down to what's happening in the risk environment. We've got low volatility on a cross-asset basis, VIX 15%. You've got the S&P at all-time highs. Can't get any more bullish than that, realistically. Tech's working well. The Hang Seng's highest level since 2021. You've got iron ore futures year-to-date highs. You've got relative growth rates working in favour of the Australian dollar at the moment. We've got a growth rate in Q2 at 1.8%, which was above the RBA's forecast. Importantly, Blake, a 1.8% growth rate, which the US is growing at a slightly faster clip this quarter, but that come down to about a 1.5% pace. And then I think in Q4 we're going to come down to about a 1% pace. Our growth rate is moving higher, and we're at potential growth. And what that means is it's the equilibrium rate where if it gets any hotter, you start seeing theoretically price pressures come through, inflationary dynamics playing through. So we're at that equilibrium growth rate. And I think as we go into 2026, that growth rate will move up to about 2%. So we've got growth moving up. We've turned a corner. The recent ASX earnings season, we saw more companies, domestic companies, those with revenues that are reporting inwardsly from domestic markets, massively outperforming those external companies that source revenue externally. And that's a really strong sign about economics now. Green shoots are emerging in the private sector. It's not just the government spending that's driving this. So we like it, relative rates, relative growth. And do you know what else we've got that's giving us really strong underappreciated tailwinds at the moment, Blake, for the Australian dollar? Political stability. I'm not going to talk about whether I'm a Labour supporter or a coalition supporter or anyone like that. It's not a view, but we do have, you compare us to France, you compare us to Japan, you compare us to the US to an extent. I know Trump's got his, he's got his measures next year. but he's taking on the Fed. He's doing all these unpredictable policies. We have a very stable and predictable policy setting, but most importantly, we've got very low government debt and a deficit which is very manageable compared to France, compared to Japan, compared to the US. And I think, again, that's a very attractive place to be at the moment when you're seeing political instability in France. And the question is what will they do to address their 5% deficit? So Australia is a shining light, Canada also to an extent, but we've got all those factors giving us tailwinds. There's not really many reasons to like the yen. I'm going on a bit of a rant here, but we've got the breakout now in Aussie yen. The question now is, can it kick? We'll see what risk appetite happens in the session ahead. But there's just very little reasons to own the yen. There's a lot of reasons to own the Aussie dollar. It's almost a Goldilocks scenario, and the technicals are responding to that. So, if this kicks, jump on board is my call there.
Well, the thing is, as you said, real men trade Aussie yen, and I'm long Aussie yen with you. And I have to say kudos, Chris. Hats off. You've been pretty bullish the Aussie economy. Last week you kind of scared me out of my Aussie Kiwi shorts, which I got out of. Just so you know, and so
I take a performance fee from you.
Yeah, I should probably give you a little kickback here. There you go. Look, I'm gonna bring up the dollar MEX, and the dollar MEX has been, if you remember a couple weeks ago, I thought we were gonna have Taco Tuesday, and I was thinking that we were gonna try to break out, and you can see there was a little bit of a false breakout a couple of weeks back, right on September 1st, and I was looking for that move to really take off, and it didn't. It kind of gave us a false breakout. I've been playing the dollar MEX to the upside, but the fact of the matter is, on a weak CPI, that might be enough to actually break the 1850 level. But I'm going to be sitting below at 1820, and you can play this as a downside wedge, as a bearish wedge, because that's what it looks like technically. I think it'll play down to 1820. But when I get to 1820, I am looking to fill my boots, Chris. I've been looking to play the dollar MEX to the long side, and that's the level I'll be looking for. So I think it's a little bit of setup for both bear and a bull in the dollar MEX. You can be on the bearish side, going into this 1850 level. If it breaks, you might be looking for a quick gain and maybe a bit of a reversal down below. So that's how I'm looking to play it. And I think it's a good setup going into the next FOMC week.
Good lads. All right, I'm going to bring up SOFR futures. So SOFR futures are, an interbank, secured overnight funding rate. Essentially, it's a way of people trading on interest rate expectations, and you do this for quarterly contracts effectively. Now, what you can see here is the effective is the market's pricing of the terminal rate. You can use this Fed funds futures. You can do this through derivatives such as one year rates, or 2 year one day rate forward rates, for example. But that's getting into a really sort of institutional world. But what I've done on TradingView is I've looked at I've put all the different SOFR contracts. And the one I've used here is SR3H, which is basically the March 2027 contract. I've got them all listed down for their respective expiries for each one, and you just basically take that away from 100 or par, and that gives you the implied floor effectively for where the market's saying the Fed could get to by basically the turn of 2027. So what I'm trying to say here, what I'm trying to articulate is using that equation, which you can see in the top left. We should be able to see in the top left. What we can do is we can look at the market's pricing, or the current implied floor, trough, terminal, for where the Fed funds rate could be taken to, or is expected to come down to. And I've drawn that black horizontal line, which is 3%. Now, that's the Fed's projections from the long run dot. Now, why is this chart important for me? Because I think the dollar looks at this one very, very closely. Other asset markets do look at this one quite closely, but I think they're going to become much more sensitive to this. So the terminal pricing of where the Fed are expected to get to at the moment is at 2.9%. That's a slight discount to the Fed's longer term dot, 3%. Now, what does that mean? It means that the market is saying, on balance, that the low point in the Fed's cutting cycle, beginning of 2027, is going to now be a slight discount to where the Fed see. Now, if that goes any lower, what that's saying to me, and it will be driven by incoming data, lower inflation potentially, but more fragility in the labor market and the growth data, anything below 2.75% and getting into 2.5% is the market saying that the Fed are going to need to take rates below a neutral rate into stimulatory capacity, and that is the repricing of recession risk. We're not there at the moment. What we're seeing in this pricing is still thematic of a soft landing. Inflation coming back to target, and the labour market slowing, but the Trump could switch back on the labour supply switch at any stage, going into the midterms next year. But if that goes below 2.75%, and the lower that goes, I think you're going to see the next leg in the US dollar coming down, because the market is therefore saying we're seeing increased recession risk, and the Fed is now need to go through neutral and into a stimulatory capacity. And that's why this chart for me is really important. It's an education day.
Ding, ding, ding. Class with Westy is now concluded. That was a great explanation of SOFR. So thank you very much, Chris. And I'm sure if you guys are at home listening to what Chris just said, the great thing is you can rewind this portion, watch it again. But the best thing you can do is jump down below, ask any questions that you have from Westy, and give him a thumbs up for giving you that information. Great stuff, Chris. Love it.
I'll share the rates table in the comments below, with all the different codes for all the different contracts. So if you're into this world, if you want to, some people just see this as noise, but if you want to see what's being priced for each contract for each month, I'll share the equations that you could just plug in and create a watch list effectively in TradingView if that's your jam.
Amazing. Thank you so much, Chris. And jump down below in the comments and thank Chris for posting that. All right, my last setup is going to be Ethereum, and I think Ethereum is a really, really nice setup for bulls and for bears should we break down. Now, as you can see, Ethereum's like just perched above it's perched above its 50 DMA, which is that orange moving average that you see there. It comes in right above the breakout point. So the breakout point is at 40.80. I think a couple of weeks back or about a month ago, we dipped to 40.60. So 4060, 4062, I believe, was the low before we bounced. And that really is I would call it your line in the sand. It's where
imaginary line.
Yeah, your imaginary line. Above 40.60, you're bullish, but we get below that, it's bearish. And if you really want a low risk entry to be on the long side, I think this is the place you want to be. Now you start getting below that 50 DMA, I think you have to start, worrying that we could see a breakdown. The top blue line that you see up there, the very, very top, that's the previous all-time high. So the risk is if we drop back below 4062, that's going to be a bit of a near-term bearish reversal. It's also a 24% retracement. I think the risk would be that we sell off back to about 3,600, which is the 38% retracement. So keep your eyes open. I think it sets up for both sides, no matter which way you want to play this market.
Lovely. All right, let's go to play of the day. Let's see what's on the mind. Well, I'm going to bring up one of the most boring currency pairs in the world. But, as we talked about before, Blake, range trading can be fun, and especially if you're making money. I love buying things that are trending and showing good underlying momentum, and I like selling stuff. But, there is a place for range trading. And now what we've seen from here is that the dollar yen is a really well-defined 146.70, 148.50 range, and it has been for a few weeks now. You can see the RSI is at 50, which basically just tells you everything that you can see on the chart, that it's just a beautiful range trading paradise at the moment. And to be fair, I can't really tell you a lot of reasons or many reasons to buy the US dollar. I can't really tell you many reasons to own the yen either, to be honest. And I think, the big picture chart, the weekly or daily chart just reflects exactly that sentiment. There are currencies out there which are working really nicely and are trending. But right now, there's not a lot of attractions in the dollar. There's not a lot of attractions in the yen. I mean, probably, if anything, I'll probably like dollars over yen. But I don't have a strong conviction. I will be going to other currencies which I like. But what am I doing on the day? Well, I'm not going to be trading CPI. I'm not going to go in there betting that we're going to get a hotter or weaker CPI print. But I want to see what happens when it comes out. I think that's probably the trade for me. We know there's going to be a bit of volatility over this. It's going to be sensitive into dollars. We've looked at the symmetry and risk. And the way that I want to play this is because we do have an element of 50 being priced in. If we do get a slightly above expectations CPI number, I'm selling dollars. I'm going to be looking to either leave limits into the top end of that range, 147.70, 146.70, maybe just a little bit above that level, just for a bit of a squeeze above that level, maybe into 80, 85. We'll have to see. I'll sort of assess it later on. But I think the trade here is sell rallies on a slightly hotter number. You've got the top Bollinger Band coming through. Again, you're getting to the top end of the range. And I don't think the CPI number is going to be a game changer in that capacity unless we get some completely blowout number. So the other way that I'd like to do this is just be in front of the screens, trade like be very reactionary, be very short, sharp. I'm not going to be an algo, obviously. I'm not going to beat them. But what we're doing is waiting for the wash up, move higher, wait for the flush out of shorts, wait for that point where you can see on a really short time frame that the market's done its thing. And look to fade moves into sort of 147.70, because I think selling to top of that in the range when we get that price action, I think is the trade. So I'm not trading. I'm not trading ahead of that because I don't have any edge in where that's going to come out. But I think the trade for me is wait for the numbers to come out, see what it looks like, wait for the flush out if we get a move higher, and look to short for a move back into the range. So it's more of a bit of a scout, short-term trade, but that's how I'm going to be playing on the day.
All right, Chris. Well, thank you so much for that breakdown of the dollar yen. And hey, rangy can be fun, especially if you're making money.
Rangy can be sexy.
So, it can be sexy. I'm going to give you a little bit of a range too, but more of a consolidation in a range, which is the euro sterling. And tomorrow, let's not forget, is the ECB. And the ECB is expected to keep rates unchanged. It should be a fairly boring ECB meeting. However, the markets are still pricing in the possibility that the ECB could cut one more time, kind of an insurance cut. And if the ECB kind of takes that off the table, there is a risk that the euro sterling could trade at the upper end of this triangle, which would be at 87 pence. Now, overall, I think this is like a bullish pennant. It's a bullish consolidation after a nice run that we've seen this year. The second half of this year, our spring, summer, if you will. And I think we're setting up for another rally. I am long going into the euro sterling because I think it's a low risk entry at this point. It's a manageable risk. And I'm actually looking to add on a move above 87 pence in the days and weeks ahead. So I think that you have your low risk entry around here, ahead of the ECB. Obviously, if the euro sterling looks a little bit better post ECB, I think it's going to set up for a bigger move above 87 pence. So that is my play of the day, and I am playing a little bit of range, but I think it's a little sexier than Chris's, right? It is.
ECB, I mean, I think this is going to be the least sexy ECB meeting we've seen for forever, really, because we've got very, very low implied volatility over the meeting. The ECB are not going to go anywhere near a rate cut. In fact, I'm talking to people at the moment who are saying, but the next move is probably going to be a hike. That's where we are in the cycle now. And, the market's still saying on balance that, we're going to get a cut for the next one, but it's not going to be anytime soon. And that's going to be the data that forces into that situation. So, we're in a situation where the ECB are just not going to be going anywhere near a rate cut today. Market's pricing that in, and they're very much in sit on their hands and wait for the next move, really. So it's going to be all the roads lead to a low impact, low volatility event. Maybe I'm wrong, but it is a risk that still needs to be managed, and we'll have to see. But the market's saying to me right now that they're expecting a very low impact event relative to other ECB meetings, and maybe that's quite interesting. But we are looking for little nuggets of information that could marry up against the long term curve. But I think it's really we just need to wait for new data to come through. I think obviously what we're seeing on the political situation in France is holding the euro back a little bit. The spreads against OATs against bunds are 81 basis points, but people are sort of waiting for this Fitch downgrade or Fitch outcome. I don't think they're going to get a downgrade, but wait for that to clear. Maybe that gives you a bit of a euro move. But France are in all sorts of problems at the moment, trying to get the confidence vote together, and then ultimately come up with a coherent budget which addresses their very high deficit levels, which need to be managed. Otherwise, people will continue to sort of trade that spread. So I think there's issues around that, but the ECB meeting, very low volatility event. Anyway, Blake, thank you very much for all your views and help today, and obviously thoughts and prayers to Charlie Kirk's family and obviously the community out there near your hood as well, Blake. So anyway, moving on to markets, and obviously good luck over the CPI print, and we'll see you back next week for more of the trade-off.